Based on a communication to his longtime clients, recently Dennis Gartman stated that today is a watershed day. The world-renowned commodity guru, who often is quoted by the media, writes that his longtime clients know that we do not write watershed reports often, and indeed, we've not written one in many years. But today is one of those days when we put our reputation hard upon the line, and we are doing so today, calling for a major multi-year top in the equity markets following the recent volatility and following the reversals to the downside that took place recently in the Dow Industrials, the Nasdaq, the S&P 500, and the Russell 2000. Mr. Gartman continued that market tops are hard to call. They take time to develop. They are messy, confusing, often embarrassing events that make those of us in the prognostication business appear beyond foolish, and at times, as we try to fit an evolving thesis into an even more difficult evolving environment. However, he went on to say that this then is our watershed comment. It is time to hold cash. It is time to sell rallies. It is time not to buy weakness. Now, although I don't completely agree with Mr. Gartman, I'm not sure if we've seen the peaks in all of the markets yet. I do believe that now is time for caution because there may be some detours ahead. So let's take a look. So it's been a couple of weeks since we've last looked at the markets, and if we recall, we were at this point here when I said that there might be some hesitation in this level here because I was looking for a W recovery. At least the probability was, to me, higher that we were going to have a W form recovery as opposed to a V formation recovery. And of course, the market's not cooperating, and it's not given me either. However, I did say that there was going to be some hesitation in this area here, which we seem to have in the recent periods. Now, the recovery did move on up to that area, and then we had a retracement here to this level. I wanted a retracement to come down a little bit lower, but of course, an uncooperative market headed right back up here. And it seems to have done a sort of step recovery, one step up, one step down, and then another step slightly higher. And we have a little bit of retracement here in the last couple of days. So until the stock or the market does make a convincing move above this level here, and then the next level, I would like to see a convincing move above the previous high. Until those two events happen, I'm going to remain cautious. Now let me go to show you some other charts that show some reasons to remain cautious. So currently, we find ourselves in a very precarious position with regard to the markets. So looking at the chart here, this is the S&P 500 index from 1929, right before the crash. So look at the chart and follow me while I read this. The S&P 500 peaked at 31.86 on September 16, 1929. Over the next 14 days, the index experienced a 10% correction. Then, over the next 4 days, stocks bounced back by 7.54%. What followed was a 7-day period of time where stocks drifted lower, and then on October 18, 1929, the low was broken and a waterfall decline ensued. The decline from October 8, 1929 to November 13, 1929 was a 22-day waterfall decline, with stocks dropping 42.68% into November 13, 1929. So now let's go to the next chart. And this chart here is the S&P 500 index from 1987, right before the crash. And the 1987 crash was remarkably similar to our current experience. Back in 1987, stocks peaked on August 25, 1987, and then began a 7.79% decline over 18 days. Stocks then rebounded by 5.65% over the following 10 days, peaking on October 5, 1987. Over the next 7 days, the low failed and a waterfall decline followed. The decline was 28.51% over 4 days, culminating in a low on October 19, 1987. So let's go to the next chart. And this last chart here is the S&P 500 index for 2018, and it's a few days old. So follow me here. In the last 40 days, we've seen the S&P 500 peak at 2872.87 on January 26th. Stocks experienced a 10.16% correction over 9 days, and then they bounced back by 7.96% over the next 20 days, ending last Friday, March 9th. So we find ourselves in that 7-day window where stocks need to hold up, and that 7-day window ends next Wednesday, March 21st. So if over the next 7 days we drift lower and take out that 2581 low of February 8th, history suggests that this may be a setup for a waterfall decline. Do I think we're going to have a waterfall decline? No, not really. I don't think the probabilities are there. However, keep your fingers crossed. So for today, that's ChewDog Charts. Thank you.